Right, welcome to another video, and this again is another walkthrough of the weekly S&P 500 ChartStorm on Twitter. So we'll just get right into it. If you're not aware of this series, just look on the YouTube channel and you'll quickly get some context, but it's pretty self-explanatory. So we'll start off with number one here, and this one is a fairly simple chart, almost deceptively simple. And what we've got here is the S&P 500 index closing above the 50-day moving average on Friday. Still well above the 200, failed to break down earlier during the correction. And what we've also got here is you can see a nice little sort of W shaped. So, there was a bit of talk going on whether it would be the V-shaped recovery or the W-shaped recovery. And I think, honestly, probably more people may have expected this W leg to go down a bit further, as we saw in the 2015, 2016 corrections. But I think, the nature of that being more of a upward W versus a downward W, if you wanted to call it that, this probably goes to the macro or the fundamental backdrop where, 2015-16, there was actually real issues going on and earnings were decelerating versus now, earnings are accelerating and macro backdrop is reasonably sound. And, I think that the reason why I say this chart is sort of deceptively simple is, and we can debate about whether the 50-day moving average is the right moving average, but the reality is that a lot of people use it. And, trend followers, momentum guys are probably going to be doing a bit of follow-through buying on Monday and the days and weeks ahead. So, I think that this one, as simple as it is going to be setting the tone for the next few weeks. And I'll go into a little bit more detail on that. So sticking with the 50-day moving average, the second chart here shows you the breadth of the S&P 500 from a 50-day moving average standpoint, i.e. how many of those 500 companies are actually trading above the 50-day. And you can see it's 52.79%, so around half. So it's interesting, right, that, while the index itself is broken above, still half of stocks that are below their own moving average, and could change very quickly. You can see that it's a kind of indicator that can move very, very quickly. But it raises the question, which brings us to the next chart around the participation or the leadership of the rally. And if you see breadth at very low levels and price going up, what that tells you is basically the heavyweights, the larger companies, are doing all the heavy lifting. And so this here chart from All Star Charts, highly recommend you look into them. And this chart here shows you the relative performance of the equal weighted versus the cap weighted S&P 500. So, if you look at the cap weights, you can see that there's a few fairly dominant companies at the top, and as we'll see in the final chart of this week, there's a few dominant sectors as well, but we'll go back into that in a minute. And yeah, anyway, look at the technicals on this chart, and it's a pretty good setup for sort of a reversal there. So it could be, that we enter into a new phase of the new bull market where we actually get broader representation there, and maybe it's time for the small caps to start catching up, pulling their own weight, or some of the lagging sectors like energy to start start performing. So we talked about energy in the weekly report actually. Some interesting stuff going on there. If you want to learn more about that, just get in touch. But otherwise we'll move on to the next one, and sticking with the idea of breadth and also sentiment, this is the breadth of Twitter sentiment from trade followers. So there's the links there if you click on that tweet. Basically these guys analyze the data from Twitter, and they use some algorithms. I don't know how it's exactly calculated, but basically the red line there is the bullishness of the average tweet that's talking about stocks. So it's capturing the tone of the conversation on Twitter. You can see the bearish tweets, or bearish stock tweets, has started to tick up a bit. What most dramatically is the bullish stocks just tapered all the way off, and it kind of looks like a bit of a washout, a bit of a arguably a contrarian bullish signal. And speaking of contrarian bullish signals, we've got here a fun fact. So for a SPY, which is a pretty big S&P 500 ETF, net flows in 2017 were plus $10.6 billion. So far in 2018, year to date, net flows have been minus $18.5 billion. So almost twice what they were last year on the downside. So, you know, that's basically people, you know, putting their money where their mouth is in terms of the whole, you know, fear aspect, or taking money off the table. But, you know, you contrast this one, you know, as interesting as that is, you contrast it with the next one, which shows you assets under management for long versus, you know, short US equity ETFs. And it's really quite interesting that the long side really didn't actually move that much, and, you know, it started increasing, so potentially people putting the long bets back on. But then also on the short side, in contrast to what you might expect, that's actually fallen away quite a bit. And, you know, I guess one way that I think you could reconcile that would be that, you know, people that did enter into these short positions have taken off some exposure, or taken profits as the correction got underway. And then, you know, as they sort of maybe got wind that this wasn't going to be a, you know, deeper correction or bear market, they decided to pull back altogether, and then add to that the market movements. So I guess that can kind of explain that. There might be some use of that, you know, these ETFs in arbitrage trades as well. I'm not sure, but if you look at the net kind of exposure, or the net position, if you would, between these two, it's you know, gone up significantly as a result of that. So I guess, you know, when you're squaring these two up, you know, outflows from S&P 500 ETF and also what it looks like almost as outflows from the short ETFs, or at least reducing AUM, in contrast to increasing, right? It's one thing to take money off the table, you know, to reduce exposure, but it's a very different thing to go outright short. And again, that speaks to the whole contrast, I guess, between, you know, if you look, that one actually, the short ETFs increased significantly after the 2015-16 corrections, because it was, you know, there was a bit more going on at that point. And on to the next one, insider transactions ratio. Not really much to say about that, except that it's in the bullish zone, and again, that's kind of lining up with the overall tone of what we're looking at this week. Click the link there if you want more detail. And the fear and greed index from CNN Money, so that's gone from extreme fear and is moving back to greed. And, you know, just before we wrap up with, I'll quickly go through these and then we'll wrap up. So the performance quilt here, this is kind of, and now for something completely different. You can see there that, well, probably the one thing that stands out to me is that, you know, you look at the reds, so the ones that were on the losing streaks, most of the time, you know, you spend, you know, I guess 1 to 3 years at the bottom of the table at max. There's been a few exceptions like telecoms and IT out of the dot-com mania. And then on the upside as well, you know, the greens, you usually tend to see not more than 2 to 3 of those. So I guess there's something to be said there about, you know, what comes next in terms of a bit of arguably mean reversion. So, you know, that can sort of highlight potential risks and opportunities there. And I guess the ones to look at or think about there might be energy again. Very interesting setup in energy. And IT on the other end. So that's one to think about. And sort of a natural flow on from that is the makeup of the index. And, you know, as I was talking about earlier on, the heavyweights of the index. You look at IT, at financials, fintech if you want to call it that, and that's that's the dominant share of the index, and what these guys say goes, and as far as what the S&P 500 is going to be doing, and there's a few down the other end there which arguably may be at cycle lows in terms of their representation. So look, tying it all together, if you go back and see fears turning to greed, inside transactions in the bullish zone, leverage short plays dropping off, SPY outflows, Twitter breadth rebounding off most negative reading in quite some time, and then you think about the breadth for leadership of it, maybe not that one so much, but if you think about where the headline price ended up, I think that sets the tone for a fairly bullish outlook from here. Certainly, if you came to the conclusion that the last few weeks were characterized by fear, then maybe it's going to be the case that the next few weeks are characterized by the fear of missing out, as fear turns back to greed, and it's going to be an interesting few weeks ahead, potentially a new phase of the bull market. And I'll leave it at that. If you've got any comments or questions, any sort of counterpoints, go ahead and put them in the comment section of the YouTube video page. And other than that, yeah, just be sure to subscribe to the channel so that you don't miss out on any future updates. Just one last thing, I quickly wanted to show you something that I thought was pretty interesting and kind of captures what I've been talking about here. So if you look at the poll here, the weekly your equities view positioning is and primary reason. So this is a poll that I do every week. And make sure that you voted if you haven't yet. And if you look at the results so far, I mean, it kind of says it all, right? Like, look at how the bull-bear spread is currently sitting, and of course, we're only at 200 votes, only still 19 hours to go, so it could change from here. But you look at it where it's sitting right now. It's at a record high for the overall bulls versus bear spread, which is remarkable. And if you look at the fundamentals versus technicals bull-bear spreads, you got here fundamentals bouncing off the 0 point. For quite a long time it was sitting below that 0 point, and then you moved into this sort of new phase of the bull market, and now you've got it sitting at a record high. Likewise, technicals, maybe all it took for these guys was to see that 50-day moving average being broken, and these guys are on it now. They're so the technicals bull-bear spread is highest point since back in November. So yeah, very interesting final thoughts there. We'll have a full update on the results of the survey tomorrow, I think. So 19 hours from when I post this video.